Welcome to Alpha Insights. I'm Hope. Today we're unpacking a mixed day on Wall Street where investors were juggling inflation readings and corporate earnings. With me is Jessica, our calm voice of reason. Jessica, great to have you.
Thanks, Hope. Glad to be here. There's a lot going on, but it's the kind of day that makes good sense to slow down and look at the forces at work.
Let's start with the big picture. Markets were mixed. Tech stocks were up while energy stocks slipped. And the Federal Reserve basically said it's keeping its current policy. How should everyday investors read that?
When you see that kind of split, think of it as investors choosing where they see growth and where they see pressure. Technology rallied because investors are still betting on companies that can grow earnings even in a slower economy. Energy fell because either oil prices eased or traders are worrying about demand. And the Fed saying it's maintaining policy usually means interest rates are staying where they are for now, which can be neutral to slightly supportive for growth stocks.
You mentioned inflation readings. How does fresh inflation data interact with earnings season?
Inflation influences everything, from what consumers pay to what companies spend to borrow. If inflation comes in lower than feared, consumers have more real purchasing power and companies don't face as much margin squeeze from higher input costs. That can be good for corporate earnings. But if inflation stays stubborn, companies may face rising costs, and the Fed might feel pressured to tighten policy later, which can hurt high-growth stocks. Right now, the market is trying to balance those signals, the data versus what CEOs are telling us in their quarterly reports.
So earnings can either confirm the economic picture or complicate it?
Exactly. Strong earnings can reassure investors that companies are managing costs and demand is holding up. Weak earnings or cautious guidance from management can increase volatility because it raises questions about the economy's direction.
The article flags semiconductors, healthcare, and financial services as key sectors. Why those three?
Each one tells a different story. Semiconductors are a proxy for technology demand. If chip makers are busy, it means strong demand for everything from phones to servers. Healthcare is typically defensive. People need medical care regardless of the economy, so those stocks can be stabilizers when markets shake. Financial services are sensitive to interest rates and loan demand. If rates hold steady or rise, banks can sometimes earn more on lending. But if economic activity slows sharply, loan growth and credit quality could worsen.
Energy was down today. Should investors worry about that?
Not necessarily. Energy moves for a lot of reasons: global demand forecasts, geopolitics, inventories and commodities, trading patterns. A single down day doesn't change a long-term picture. If you're invested in energy for diversification or inflation protection, short-term moves shouldn't force a change. If you're trading it, then you need a view on oil and gas fundamentals and a clear exit plan.
Volatility was mentioned. Analysts expect it to continue. For someone who's nervous, what practical steps can they take?
First, check your time horizon. If you're investing for retirement years away, short-term turbulence is normal. Second, diversify across sectors and asset types, so one sector's weakness won't derail your portfolio. Third, consider dollar cost averaging. Investing a fixed amount regularly reduces the risk of mistiming the market. Fourth, review your emergency fund and risk tolerance so you aren't forced to sell when markets wobble. And finally, stay informed but avoid headline-driven panic. Use earnings and economic updates to refine your plan, not rewrite it every week.
Any specific signs investors should watch in the coming weeks?
Watch next rounds of inflation data and corporate guidance. Pay attention to semiconductor order trends and healthcare earnings for resilience. For financials, keep an eye on lending growth and any changes in credit quality. And watch how the Fed frames its next communications. Subtle language shifts can move markets.
Quick practical checklist for listeners who want to act but not overreact?
Sure. 1. Confirm your investment horizon and goals. 2. Rebalance if a sector has drifted far from your target allocation. 3. Prioritize high-quality businesses with stable cash flow if you want lower volatility. 4. Keep some dry powder, a little cash to take advantage of opportunities if markets dip.
Great guidance. Jessica, thanks for walking us through this mixed market day.
My pleasure, Hope. Remember, uncertainty creates both risks and opportunities. Plan around the first and look for the second.
And for our listeners, here are 3 quick takeaways to hang on to.